Good morning or afternoon, depending on where you are. My name is Dante St James. I'm going to be taking you through this session on budgeting and keeping it on track if you're a small business owner, particularly for sole traders and those who are working on their own, maybe from home, maybe doing their own sort of side gig thing to keep that budget going correctly so you're not losing track of your financial motion forward. And we want to keep that motion moving forward. There's some concepts that are going to come up today, I warn you. They're going to be a little bit out there, a little bit weird, and they're going to feel a little bit technical, but these are sound accounting principles and sound bookkeeping principles taken from my experience with the bookkeepers and accountants that I've been able to work with. I will continue and share this screen in just 1 second and we'll get underway. So welcome to Basic Budgeting for Busy Businesses, and it's all about sole traders. It's all about you, pretty much. The sole trader who needs to understand a little bit better how they're going to manage their finances. First of all, though, a quote from Dave Ramsey, who hosts a very, very famous show on radio in America, which is all about budgeting and small businesses and financial management. And he says a budget is telling your money where to go, not where it went. It's not a post-mortem. It's to tell you in the future where the money's supposed to go and how it's supposed to perform. This is brought to you by Business Station and the Australian Small Business Advisory Services Digital Solutions Program in association with Regional Development Australia, Brisbane in Queensland, and Treaty Business Consulting in the Northern Territory. And the best part of this is, if you're watching now, you can miss a little bit here and there, and you'll still be able to pick it up on YouTube later through the Business Station channel and through my own one, under my name, Dante St James. If you're watching on YouTube though right now and you'd like to leave a comment or ask some questions along the way, whack them in down below in the comments, and also smash that subscribe button because we want to get you able to see these new videos as they come up. Whichever the channel is you're watching, please subscribe. So who this is for today is for freelancers, it's for sole traders, it's for we're talking about people who work from home, have small businesses, micro businesses. They could be a Sparky, a Chippy, anyone who is struggling to get the idea of what they're meant to be doing when it comes to the budgeting for their business beyond just simply invoicing and reconciling their accounts. A little bit about me. My name is Dante St James. I've been in Darwin in the Northern Territory, although I work across North Queensland and Northwest WA as well. And I'm a Facebook Australia lead trainer. I work with Google's Digital Springboard program, have my education across the University of Western Sydney, University of New South Wales, hiccup there. And I work with Treaty Business Consulting out of Darwin in the Northern Territory as well. And I actually own 3 businesses now. I've had 3 businesses in the past. A couple of them didn't go so well. A lot of that to do with financial problems. This is why I'm helping you out, because I know what I went through when mine all collapsed. And then the most recent 2 businesses I've worked in, I've actually worked really well to the point where I've actually sold one. And I'm actually now working in a new one, which is doing really well and traveling along very well because I've got the right stuff set up. So what we're going to cover is the attributes of a budget. We're going to look at planning out your budget. We'll look at the sales and production and cash budget and what they all mean. There's a thing called historical budgeting we're going to look at. There's another one called zero-based budgeting that we're going to take a look at as well. And we're going to look at budgetary variance analysis. That sounds much worse than it actually is. Capital budgeting, and a few calculations that are going to be really handy for you. They're helping to keep all this stuff in lock. Now, I am not a bookkeeper, a tax agent, or an accountant. So any advice given is not advice. It's just general information, as I'm not a financial professional. You can see a bookkeeper, accountant, or a licensed financial planner for any information about how to manage your money better. And I really thoroughly recommend beyond all to get a bookkeeper or an accountant. I've got both, one to handle my tax, one to handle my BAS and my day-to-day stuff as well. And they have more than paid for themselves many times over. I hate doing the books. I had to learn enough about the books to be able to know what I'm doing with these particular people in my life. And since I've had them in my life, things just flow so much more smoothly. Still got a tax debt, mind you, but that's not their fault. That's me. A budget, when it comes down to it, is a document that outlines how your money is going to be allocated. The money is coming in and where it's going to go out to in an expected format, I suppose, where you know where those things are going to go, where your expenses are going to be. The benefits are pretty obvious. You know what's coming. You know what's going to go. You're coordinating departments if you've got a business that's got a couple of different departments, and it helps you to collaborate better on projects because you know what's actually going to come and what's going to be expected when it comes to expenses. But we tend to not like our budgets very much because it feels like we're micromanaging everything, and it feels like there's favoritism going on when things get budgeted to certain places better than other places. Staff, if you've got them, often can't see the big picture of where the money's going, so they may feel that the budgeting is something that's actually disadvantaging them, which is never usually a problem. It's just because you, as the owner of the business, tend to have that big picture view of what's going on from the start to the finish, because you are the owner of it. You see it, you look at it from up here, whereas your staff or your contractors may look at it from down here. They see the details, you see everything, including the details. Potential problems that can pop up with budgets include that when you've got departments, they can inflate their requirements, or if you've got like contractors, or you've got a staff member, or if you're just looking at a budget within your workplace, quite often budgets can be kind of inflated out. That people say, oh, look, we're going to need a lot more than we actually need for this particular activity or this particular business as usual project. You can make a budget say essentially whatever you like. But when it comes down to it, that budget's then accountable to your accounts processes. So if you say your budget is this, yet you're going and doing something completely different, then your budget's pretty much worthless. The budget is there to ensure the long-term stability and the long-term sustainability of your business. It's not there to be micromanaged. It's not there to cause problems and stress. It actually just helps give you some milestones along the path that tell you, okay, now you've reached here. And then you can look forward to the next one and go, so in 3 months' time, I'm going to be there. That's great. That's what I want. That's where a budget can be really useful. So what is an effective budget? What does it actually contain? If you've got a team, you can involve a team in your planning. I always say that it's not necessarily just you. Even if you're a sole trader, it's something which you can actually put in front of someone else, another sole trader, an accountant, a bookkeeper, and say, look, is this realistic? You may have to pay someone for their time to actually go through that with you, but it's definitely worth doing to say, is my budget looking realistic? Does it make sense? Or am I just pie in the sky with this? Am I just thinking that I know what I'm doing, but I really don't? It defines your goals in actual numbers. So you might have goals and dreams for the future, which is to have a 7-figure income within 2 years. That's great. You should have goals like that. This actually puts it down to within 2 years, I will be earning $53,000 a month from my online business. So it's giving a real figure to look forward to rather than just an idea saying, oh, I want 6 figures. Oh, I want 7 figures. Oh, I want to be wealthy. Oh, I want to be able to go on a holiday. This actually puts the goal in numbers and in dates and timelines. A budget, though, is not set in stone. It should be able to change along the way. If things like the coronavirus pandemic pop up, you should be able to adjust your budget to be able to suit the times that you're actually living in. A budget that doesn't live in the real world is just not a budget that's ever going to work for you. You'll never be able to stick to it. If you make your budget so strict that you can't move, you can't buy yourself that bunch of flowers, you can't go out for dinner once a fortnight, then your budget's probably going to fail because you won't be able to keep up with that. Life gets in the way, and we're human. We need to be able to have some joy in our lives and be able to spend a little bit of money here and there. So let's get down to planning a budget. Take your time, take a breath. It's not a race. You don't have to do it all today. And you don't want to miss stuff. This is the biggest thing when someone is trying to set up themselves to have a budget. They want to rush the process, get through it, because it's not the most fun thing to do. It can feel really boring, but there are steps along the way which are absolutely vital that you do not want to miss. So where do you start? Well, you start at the very beginning by sitting down at your desk, piece of paper, and probably your computer as well, and looking at what your goals are. Now, this seems like that most up in the sky in the clouds kind of thing, but setting your goals for your budget means that you know that you want to either grow or you want to contract the business back a little. Do you want to shrink it a little bit? Are you trying to overcome obstacles on the way? Is it trying to pay down debt? Is your budget going to be allowing you to buy a new house next year? Or is your budget just all about just keeping everything the same as it's always been? It also allows you to put in things such as what's new. So you can say, yep, this is a new thing that's in my world right now and in the world of my business. I can now set this goal. So the new thing could be that you have a baby. Babies are expensive. Anyone's had a kid will tell you how expensive those little things are. And they don't stop being expensive for 18 years and even afterwards then. So what are your goals in terms of the things you want to achieve with your money and your business? And you start from there. Once you've got those in place, then the rest of it kind of makes some sense. The problem is, though, that we think we know everything, and we certainly do not know everything. In fact, we really need to get input from other people because they can show us the areas where we're missing something. They can show us the gaps. They can say, hey, did you think about X? Did you think about the fact that you pay a car repayment? Did you think about your rent for your business? Did you think about the cost of what it's going to be to get in the raw materials for that product you're trying to sell? Did you forget about Facebook ads? So someone there sitting down with you, whether it's a financial planner, advisor, accountant, bookkeeper, or even just another business owner, they can help you to actually think of all those things that you may not think at the time, especially if you're someone who's a very big picture person, you don't like the details. I'm that guy. I'm very much the big picture person, not a fan of the details. I do need to sit down with someone else when I do my budget up and when I redo my budget to make sure I've got everything I can think of. And then I might find another additional person again, and then I'll run it past my bookkeeper who will go, based on all the things you've done in the past, here's the things you're forgetting, add those in and your budget makes more sense. Oh, it makes it so much easier. But it also lets you think of, are your targets and your goals realistic? Because you might think they are. They might sound great at the time, and then your best friend comes along and says, are you kidding, man? You're not going to stop doing that for every week. You're going to want to go for a drink every Saturday with your friends. You're not going to stop doing that. Don't pretend you're not going to. And then that sort of makes you think, oh, yeah, okay, maybe it's a good idea that I don't be so tight and so strict on myself because I've still got to live a life. Now we're going to estimate what you need. What money is needed to be able to run your business? So this is where you're going, I need this amount to pay my rent. I need, $350 a month to pay Facebook and Google ads. I need my $120 a month to pay for an ASBAS digital solutions advisor because they're helping me to set up on digital stuff. I need to go and buy a new microphone to do my webinars. I need to buy a ring light. That's another $25 or $35 at Kmart. If you want to be able to, all those things it takes to actually run your business and do your business, internet connection, laptop repayments if you're doing that sort of thing, afterpay repayments if you're afterpaying other computer equipment, what it's costing you to run the air conditioner, turn the lights on, to be able to buy the coffee pods even for your office at home. All these things need to be adjusted into what you think you're going to need in the future. And then also how much time is needed. A budget doesn't have to be a 3-month, 1 year, 6-month thing. It can be a weekly thing. It can be a monthly thing. How much time is it needed to do certain things? So you'll go, I need to go and I buy materials. I need to buy the ingredients and the herbs and the botanicals for making my essential oils every month. How much time and money is needed? Do you buy that every month? Do you buy it every quarter? Do you buy it once a year? And so look at how much is needed over the period of time that you need it for. And then also look at whether more people are needed. People cost money. So if you need to go, I'm going to need to speak to an advisor at that point. So making an allowance for that kind of money to come in is going to be really important. I'm going to have to talk to, I know, my bank account manager. You might need to do that. Or it might be something as crazy as I need to now move myself out of the home office because the kids are coming home earlier from school, or there's a lot of disruptions at home and I now need to rent myself an office somewhere else. You're trying to have a forecast of what you're going to need in the future. Now, it doesn't have to be exact, but the closer you can get to it as being exact, it's going to make a big difference to you. It's going to mean that you can know what's coming and there's no surprises apart from the actual surprises that do pop up. And then you can say, if I make a change here and there, I tweak this and turn that knob over here and only allow myself to have 1 coffee out per week instead of the 10 that I'm having at the moment because I have so many meetings, what does that actually impact? Does that mean you cannot now have meetings out at cafes with your clients? Great. Okay, then if that's the case, then I'm going to have to bring them somewhere because they're still going to have to meet and I'm still going to make them coffee. Are they coming to my home office or do I have to now get another office? you've got to look at what the impact of what each little change you're making is going to have on other things you do, such as you're going to change the brand of paper that you use for your printer from Reflex to Kiji paper. Now, Kiji paper is what you get from Officeworks. It's kind of like their home brand. It's crap. It locks up printers all the time, and it's just a terrible paper to be using. Reflex, so much better. It goes through. It just seems to be the right grade that goes through printers right. So you've got to know that if you're going to cut back on certain things, it may have an impact on other things. In my case, it's going to wreck my printer, and I might actually ruin my printer to the fact that it's not usable ever again. So bearing those things in mind, that cutting corners sometimes is not the best way to go. But sometimes there's things you're doing, such as you buy flowers every week to put in your office because it makes your office smell nice. Well, you could just as easily, instead of spending $80 on flowers, spend $30 on a little wax melt thing and put in some little wax melts from any shop anywhere that sells them, and that's going to give you that smell and that appeal to you and your clients without you spending $80 a week on flowers, if that's something you do or is important to you in some way. So a detailed budget is something which you need to get some feedback on before you release it out, particularly if you're working in a workplace or if you're working in a place that has lots of departments, or you own a business that has a number of staff in it. Be prepared to have amendments come in. If you need to get that feedback from other people, if you need to get other people's input, be prepared that when you send out that budget, they'll send back something that says, actually, that's not realistic. It actually costs this to run our department. Or you might say it costs this. The sending out of these things for amendments and requests for amendments from others, it isn't necessarily something you need to have a big business to do. This may be quite simply that you turn to your husband and say, hey, have I missed something here? So again, we're talking about these checks and balances with people, making sure that in a detailed line by line that you have for every single expense that you think you've got coming up, and every single piece of a piece of revenue that's coming in as well. The amount of times I forget to add in particular line items of revenue that I know are coming in, because I work 5 different contracts and work with private clients as well. So that means that my budget is quite complex. It means I've got to remember that I've got a bit coming in here, I've got a bit coming in here, got these clients here, and I've got another contract over here. Sometimes I forget one of those sources of income, and I look at my budget and I go, oh, I'm looking like I'm going to make a loss this month. That's not right. Until I forget that I've forgotten all about the $3,500 that comes in from a particular source every month. So I'm just trying to hold back some hiccups here. It's quite a weird feeling. Now, your master budget is the budget you'll have at the end. This is once you've done all those checks and balances, once you've got the feedback you need, once you've really thought about every single line item that's going in there, your master budget is the one that's providing you with the guide to the map of where to go. So it's the one that says, this is my budget. This is the one that's in Excel, that's in Xero, it's in wherever you need it to be. And this is where we're going to go. This is what I'm going to spend. But within budgets, you often have mini budgets. There's little budgets that live inside them. So in the case of your big budget, you might have a sales budget that's all to do with what your budget is for going out and getting new sales in. So it might be a marketing budget even, that it costs you a certain amount every month to send out ads that would then attract a new sale. You can have a production budget. That's quite often what happens when you need to make a physical product. If you've got things that you need to bring together to make into a product, then that could be a production budget. Your cash flow budget could be what you need to have in place coming in order to have solid cash flow, so that when things do need to go out, the money's there to do it. So it's not just money in, money out. It's money in, a big pot of that money being held, and then money comes out of that pot. You might have an administration budget, how much it costs you to do admin. In my case, it costs me $250 a month for my bookkeeper to do my bookkeeping for me. And then it costs me a bit for my accountant to do my annual tax return as well. Then we've got research and development budgets. If you're doing a particularly, I guess, a more technical product or a scientific project, you may need to have an allocation of budget for research and development to produce new products or to produce new services. May take research time, which of course costs money. And there could be a capital budget, which is for building things like infrastructure. If you need to build a shed out the back of your property with which to do your freeze drying of bush foods, well, then that might be something that you need to put in as a budget for the capital. It's a bit of an investment. And a functional budget, this is a good one here, is a sales budget, a production budget, and a cash budget. So in this case, you are talking about the kind of things that are functional for most businesses that have something that they need to make, a physical thing they need to sell. So we're talking about something like what it's going to cost you to market your product. So you've got a big budget and you might break this down into little segments. And one of those segments will be your sales budget, which is to do with your marketing. How much is the cost of sale? How much does it cost to get somebody out there to sell this to somebody? Do they need to have a car? Do they need to have fuel reimbursed? Do they need to be paid as a person or as a, even as, commission basis? What is the cost of that sale in terms of commissions? Then your production budget, like we said, is something which is what the costs are of the things that need to happen in order to support you having a product to sell. And the cash budget is then how much you're going to have in terms of what is the cash on hand. So if you need to go and set up a Christmas party for your staff, you can do that because you've got cash on hand with it. That's a functional budget. It will also include something like this. So sales budget predicts how much you think you're going to sell. So this is not just in terms of money, this is also setting goals. So your sales budget will look at the number of units you expect to sell in a particular quarter or a month or however you decide to do that. You'll then look at what your projected sales income is. So how much, if you're going to sell 100 items at $1, you're making $100. That's the revenue, the income that you feel that you're going to make. As that goes up, your forecasted sales will increase. So if you're going to sell 200 next month at $1, then you're going to make $200. So you follow along what it takes to make that revenue appear in your big major account at the end of it all. It's not so much about how much that you will make, it's about how much you're projecting you're going to make. So at this stage, we're only projecting, we're saying this is our estimated sales, this is our projected income, this is our forecasted sales. It's all about what we think it's going to be in the future. Remember that quote at the very beginning, it's not a post-mortem. A budget's all about where our money will be allocated in the future, not about where it has been in the past. Even though we can look at this in terms of getting information out of the past and putting it into the future, into our budget. These sales budgets are usually broken up in the quarters. Most companies will do that. You may think that it might be better for you to have a monthly one. I know a lot of people in courses and coaching and sole traders who work from home selling a lot of affiliate marketing and network marketing products. They work on a monthly cycle. But large companies, car yards even, and automotive companies will work on a quarter because obviously the reporting requirements are quite complex. They don't want to be having to do that every single month. With your production budget, it's making sure you have enough to produce what you want to sell. This is all about that cost it's going to take. So if you look at your estimated sales volume, and this is where your sales budget and your production budget are going to come together. Your estimated sales volume is how much you think you're going to sell. We covered that. Then we're going to say how much we actually then need to have left over. So if we're going to sell 100 and we've already got 200 in stock, then we're desiring to have 100 left in stock. So our total needs really is to have 200. Some of it's going to be there, some of it's not. Or if we say we've got nothing right now, we want 200 in stock. We estimate we'll sell 100. Our desired ending inventory is 100. 200 are going to be made, 100 are going to be sold, 100 are going to be in our desired ending inventory. If this screen was a little bit more interactive, I could actually put these numbers in the graph for you so you can follow along with me. Then your total needs, yes, that's 200 because you need to take a whole lot, but we might already have 100 in stock at the beginning. So we've got 100 in stock. We know that we're going to sell 100. We want to have a desired inventory at the end of 100. So we're going to go, well, that's going to leave us 300 that needs to be there. If we've already got 100 in stock, we only need to produce 200. Hopefully that makes sense to you. There's a lot of words in there that usually make a lot more sense if I'm doing it, say, on a whiteboard. But what it is I want to sell this many, but I've got this many already in stock. and I want to have this many left in stock by the time I sell it. So if I got 100 in stock, I want to sell 100. I've got enough in stock, but I want to have 100 left at the end. So I actually need to make 200 in order to have 100 left at the end of it all. It seems so complex, but when you put this down in a spreadsheet, so if you're watching this now, or you want to maybe pick this up on YouTube, put this in a spreadsheet and then use your figures like that. It's always about how much I want to sell, how much I want left at the end of the month when I've sold that, the total amount I need to make, minus those that I've already got on hand, equals the number of units you need to produce to keep that service up. That's a lot of numbers. Your cash flow budget is what you've got, what's coming or what's going out. So very simply on screen, you're beginning with $18,000. You're going to get 10,000 in plus another 40,000 from sales of your items. You've got a loan coming in for 17,000. So when you subtract what your expenses are, in here there's capital expenditures. So that could be building that shed. It could be your dividends, which is paying out to your shareholders. It could be loan repayments to pay off the last lot of loans you got. Then you can see that you're going to have a different level coming in, coming out as coming in. This is called your cash flow. It's very important to know how much is already there. Then you can add in what's coming in and then take out what's going out. This is the core of a budget, is cash flow, is understanding what's already there, what's coming in, what's going out, and what the end picture of that is. So if we were to add all that up, I'm going to open up my calculator because I'm not very maths oriented. I'll put that up on the screen and you can see what I'm going to do here. Hopefully it'll work. Come on, buddy, you can do it. No, it's not going to work up there. But if I just type in, say, for instance, I've got $18,000, then I'm going to add 10,000 to that, plus another 40,000, plus another 17,000. I've now got $85,000. So 18,000 plus those additions makes it $85,000. But I've now got to pay capital expenditure of $15,000. So I'm going to take that away. Then I'm going to take away the $5,000, then take away $10,000 for loan payments. And I'm left with $55,000 in the bank. So my beginning cash was $18,000. Once I've got all my income, once I've paid all my bills, I've got $55,000 left over, which means I've got a profit coming into that next month. That's a really happy budget to have. That's the kind of one you want to have. Now, this may be just for one, or it may be for a whole year, but it's saying they've got $55,000 left. That's what I then use to pay myself or to invest in the next thing I'm going to do. It's important to know you have that cash flow. You don't always have to have a huge positive cash flow, but to run a business, you do need positive cash flow of some degree. You need something showing that you are actually showing a green figure at the end of it, not a red one. So now we kind of get into the more technical side of what budgets are. The two main budget types being historical, because it's these companies where they have something that nothing really changes from year to year. It's always the same. They produce the same amount every year. They have the same amount of customers every year. The pricing stays the same every year. It's very, very predictable. It doesn't really change from one year to the next. The problem is this is rarely the case outside of long-term things like government contracts, or long-term things like people producing it for defense, where things are always the same, nothing changes. But the problem is that things eventually do change. Nothing stays the same forever. So in this case, you'll have something like COVID-19 coming up, which completely throws a lot of those different government and defense contracts out the door, and new ones are then formed, or a change of government can occur. So you might have had the same government arrangement since, say, the Liberal Party got into power in, what was it, 2016, I think it was, something like that, 2017, something like that. And then suddenly we change to a Labor government in your particular state or territory, and then all the contracts are removed and new things are coming in. Different things can have different impacts on you. So historical is not often the best way to go. You really do need to know that things aren't going to change at all. Now, not that many businesses are now doing that. There's still some around that have got very long-term contracts with things like hospitals or things like defense, where it's a very fixed item. It never really changes. The reality is you're probably going to have something called zero-based accounting. And this is what Xero, the accounting system, is actually named after. you're starting from point zero, and it's assuming that nothing is the same as last year, that you are just going, I've got money in the bank here. I need to redo my budget this year to make sure that I've got the right kind of setup for this coming year. Nothing could be the same. It could be completely different. I'm going to question everything that's in there in the last year, and I'm going to reevaluate everything I'm talking about when it comes to what's coming up in the future. So zero-based accounting is where most of you will sit when it comes to your business. It's not necessarily important for you to know that you're definitely going to be doing this, that you're going to necessarily be someone who is understanding the difference between historical and zero-based accounting. Just understand that when someone talks about zero-based accounting, this is probably you. You're going to start and have a different year than what you had every year past, and you need to question and reevaluate everything that was in there and start again from scratch, making sure you're doing the right thing. Now, it can be a little time consuming, and it can cost a little bit more to get all the right information together, but just remember, your past performance does inform your future performance. So you can take across a lot of the stuff from there, knowing that you got some things are the same and some things are different. Some things you can predict, some things are going to be a little bit harder to predict. So don't just get too stuck in it thinking, oh, I don't know really what to do, because the reality is you're going to have a hybrid. You're going to have some things that are historical in those areas you can predict. Some things are going to be zero-based because they're completely unpredictable. You cannot say that I'm going to definitely have this many people in my yoga studio this year, or I'm definitely going to have this many people in my acting classes this year. But you may be able to say that my rent's going to be the same. That's historical. My power is going to be exactly the same, so it hasn't gone up. That can be historical. And it could be things like your loan repayments that you've been paying off your studio build are the same this year as what they were last year. Some things will be the same, some things are not going to be the same. So that will be the hybrid accounting model. Now, the budgetary variance analysis sounds like the most technical thing ever, but really what it comes down to it's the difference between what you budgeted for and what actually happened. It's the gap. So that's what they call a budgetary variance analysis. And this is helping you to look at why there's a difference between what you budgeted for and what actually had. Now, what we call negative variances is where there's things that cost more than you thought. There's things like tax that's bigger than you thought it was going to be, or an unexpected drop in sales. Remembering that things are unpredictable. We're living in very different times. Things can change rather quickly. So it'll show in here that we actually planned to sell 75 things. We planned to sell 100 things. We actually sold 75. So the variance is 25. In this case, is minus 25%. So budgetary variance is 25%. That's a really easy one because it's in 100. We wanted to sell 100. We only sold 75. We're down 25. That means we're minus 25%. Now that would tell you that something happened there. It was unexpected. The analysis side of this then is to go and look at why we didn't sell so many. Was there a particular factor in the market that have caused that? Was it that our sales rep didn't do the right thing? Or it's just quite simply, one of those things. It could be a seasonal factor. It could be that our plan for 100 was actually unrealistic. If we had have said 70, that would have been more realistic and we would have had a plus 5%. So sometimes the things that we plan for don't come through, not because of bad things, but just because we didn't plan it right. We just had an unrealistic target that we're trying to hit. Positive variances are things like where we've had a reduction in costs that we weren't expecting. Things like less tax if there was a tax cut. Say, for instance, this past year, we had a couple of quarters where our BAS didn't have to be paid and there was an offset that the government gave us. That extra $5,000 in my BAS, oh, I tell you, I was very, very happy to get that reduction. That I didn't have that $5,000 cash at the time. And so getting that big lower amount really, really helped me. Or it could be that you had more sales than you expected. And so therefore you had a lot more income coming in to be able to offset that. So the positive variance can be a great thing. Negative variance can be a horrible thing, but at the same time, it's very educational. If you have a positive variance, you don't have the stock on hand to be able to take, then you're actually in a bit of a negative because you still owe customers that stock that you have to make and you have to produce and you have to spend money on to do. And if you don't have a good cash flow set up, you may not have the money for the materials or for the ingredients to be able to make that extra lot for the customers who prepaid and pre-purchased something from you. So how do you know whether you're kind of messing up in this area? You got to look at it regularly, monthly intervals. You've got to make sure you're checking it often so you can see the little variances that happen here and there that indicate a bigger problem. So let's just say that you are planning for $100 in direct wages and you actually only had to pay 25. Great, you had a bit of a rise. Then your cost of materials, you plan for 2,000. It was actually 1,500. Great, 25% there. And your overheads, you plan for 2,000. You actually got 1,000. This all looks really, really good. This is what we call a generic variance report. And this is a very happy, glowing one. You expect it. But what this doesn't say is that maybe your plans are a little too perhaps optimistic. So you're planning for 100 and you actually only got 75. Just giving yourself a positive variance over here is not the aim you're looking for. You're actually looking to grow your business. So you're planning ahead of what is actually realistically achievable. In 1 month, that may not mean much, but if that's happening month after month after month, you're always coming under your expected direct wages, then your expected number, your planned number is actually probably incorrect. You're being too conservative and saying, oh, I'm planning to spend 100, but the reality is you're only ever going to spend 75 until you hire someone else. So that's something to look at to make sure that you're being realistic and accurate about it, not just trying to paint a pretty picture with lots of green lines. Your capital budgeting is when you need to actually make sure that you understand what it is you're investing into, whether it's a new car, a new computer. I'm looking at buying a new computer at the moment. And so I'm looking at exactly this, the capital budget, to see, is it worth me spending this extra money right now ahead of the rental computer I've got, which I pay a certain amount for every month. It's $250 a month. Then I can spend that. Instead, I can get a $6,000 computer, which is equivalent to own it. Or there's new Macintosh computers that have come out, which probably could get away with something that cost me about $2,500 instead of $6,500. Big difference, big variance, but is it worth spending that extra money, or am I better off going on and renting? It all comes down to what the payback period is. How long will it take me to pay back what I spent? So this is where I get a new computer, which operates a lot quicker, it's a lot faster, it's much nicer and really does its thing. Or whether I'm going, well, actually, whilst that might be the case, that it might get me things done quicker, how much time is it saving in terms of money that it will take me to pay back that? So if I have to buy something which costs me $1,000 more and it's saving me up to 20 hours a week, how many weeks does it take in increased efficiency to be able to pay back the cost of that computer? If it's an extra $1,000 to what I've got now, I need to make that $1,000 in savings or increased revenue to make it worthwhile doing. And this is where we get a little bit stuck because we like to impulse buy things. I'm bad with mobile phones, and I've actually banned myself from buying a mobile phone this year. I got one last year. That's fine. I do not need another one this year because I've got 3 phones. I've got 2 for different government contracts I work on, and I got my own personal phone as well. I don't need to buy a new one because the phone that I got 1.5 years ago is still fantastic. I still love it. It works really well. I do not need a new phone. There is no payback period that's going to actually pay for that because I'm so far not wasting time by having this particular phone. Whereas my computer, for instance, may get to a point in the next year where it starts to work so slowly that it's slowing down the work that I can do and costing me money. So the payback period will be quite quick with that, as long as it has cut my production to a certain point. And this is where you have to be very logical about your spending, very logical about the things you're going to buy. Is this ring light going to make any difference to my webinars? Well, it actually has. It's meant that the end result is, by having a ring light that's much more clear to be able to see me on the screen, means I can be more engaging and more people will come to my webinars and I get paid better. I love that. That's a good payback period. The shorter the period of payback, the less risk you're taking. In the case of a $35 ring light, I made that up in 1 webinar. The longer the period though, let's say a $6,000 computer, it's going to take me 24 months to pay off. Well, that's a bit more risky. It's not as clear what the actual time save is going to be. In fact, there may be no time save whatsoever. It could just be a vanity product like me with my mobile phones, that I'm actually just buying a mobile phone because I want to get the new flashy thing, which does the new flashy stuff. If you don't consider cash flow after the investment, where you got a long payback period or a payback period that isn't even realistic, it doesn't then look at your cash flow after you've made the investment. If I've spent the extra $6,000 on that computer, I'm talking about having a cash flow that's kind of negative. So it's saying, look, I actually didn't make any, that the payback period is so long and so distant that it's actually having no real impact on my day or my week. So I'm better off just considering what I'm doing. Or it doesn't consider the changes to what your money can buy over time. Say, for instance, when it comes to working with, what is it? With, let's say about a computer like from Apple. So Apple's computers have changed in price quite dramatically. They've now got computers which are significantly more powerful, but less costly than computers they used to have. So what used to cost me nearly $6,500 to get the power of, now is costing me about $2,500 to get a very similar level of power as what I've had before. That's a significant difference in cost. So the money is going to buy me a far better computer over time than what it's bought in the past. I've got to consider that before I invest in a $6,000 computer, that next year a computer could come out, which is going to cost half as much and do the same kind of thing. So you've got to consider what the changes ahead of time are going to be in order to make sure your payback period is within that nice short range and not super long. You don't want to risk actually making a loss on things that you are investing in with your business. Then there's your net present value, the total present value of returns. So it's things coming in minus the present value of your investment. So this is how another approach to how to look at how to budget for new things in your business. So I'll use the computer example again. The return of me having a new computer is the equivalent of $1,200 worth of additional productivity every month. But if it's costing me $250 extra per month to do it, I'm actually making a positive net present value. But if I'm paying $1,200 for a month to have this computer, and it's giving me only $600 worth of additional productivity, then I've got a negative net present value of $600. So I've actually gone very risky rather than going for the much safer option. So when you look at the things you buy for your business under this lens, it kind of reduces your impulse spending just by natural factor. You're just now looking at it and going, oh, this is a little scary. What's going on? This feels really, really different and strange. I shouldn't really buy this extra thing. There's no reason why I need another speaker for my computer, because there's no net present value that's positive by buying that. It doesn't give me any extra value to my life or any extra productivity to my business. It's not saving me time. Yet I might do the same by employing a bookkeeper. That $250 a month is saving me at my current hourly rate, which is about $180 an hour. It doesn't take me long in time of saving to go, okay, it's going to cost me more time to do all my bookkeeping every month, which is around about 4 hours of time every month to do. It costs me less to get someone else to do it than what it costs for me to do it. And it allows me in that 4 hours to do the things I do well that make me money. So when you start to look at investments in your business and hiring people and outsourcing, and you put it in terms of net present value, then you start to see, I get that 4 hours at $180. Let's just take out the calculator now. It's 4 hours times $180 an hour is $720 a month worth of value that I could be making, plus all the money, the extra money that could come in. That's just my time that I'm accounting for. If that extra time in that 4 hours was made an extra $1,000, let's just say of $1,720, that minus $250 that cost me for my bookkeeper to do 4 hours of work for me a month means I've made a net present value positive of $1,470. That's a good thing. That's a great thing. That means that I've made a great investment. This is why I got my bookkeeper on. Early in my business, I could not be convinced of the value of a bookkeeper because I said, I can do it all myself. And I did a very bad job of it because I don't like doing it and it takes me a long time to do it. My bookkeeper can do it in a third of the time it takes me to do it because he does this all day. He loves doing this stuff. But now I've freed myself up for an extra 4 hours, which saves me 4 lots of that $180 an hour, plus the potential what I'm able to make from other people in that time means that that net present value is $1,470 every month. It is worth me getting a bookkeeper. It is not worth me buying a new mobile phone because there is no net present value that's in a positive to be able to do that. And then you can look at an internal rate of return, which is your net cash flow. So that's the money that's coming in that's left once you've got the money coming in and money coming out. The required rate of return. So this one, don't even bother. Like it makes no sense to me as an average person and not an accountant or a bookkeeper. So I don't even bother with this one. I just go straight with this one, the net present value. It tells me exactly what I need to know about the things I'm going to then go and invest in. The internal rate of return, as I said, it feels complicated. It's based on things that don't change. It's based on things that you can predict, and it gets less useful over time anyway. So stick with your net present value. I think it's the easiest way to do it. There are tools that are going to help you out a lot in this. Things like Xero will help you out. FreshBooks is another one will help you out that calculates a lot of this for you. Wave Accounts is free and allows you to start off for free and then grow out from there. MyOb, Reckon, those kind of accounting tools will help you to understand these concepts a lot more. But the ultimate thing is setting an accountant or a bookkeeper who can set you up with all this. Google has a bunch of free templates for budgets through their Google Drive product. They've got their Google, what are they called? Their Google Sheets that has templates that allow you to set these things up. So you can just enter the figures and it calculates it all out for you. So you can do things like net present value and so on and so forth. So the ideal would be to get an accountant or bookkeeper to set this stuff up in a system for you so you can really understand what the point of it is, how you can then use this to maintain a really realistic budget that makes sense, that's going to be easy for you to follow, and it's something that you can then look forward to actually doing. My bookkeeper just gets me to reconcile stuff now. He says, I just need you to match up this 25 items this month to make sure everything balances out the way it should be, and you've got a good budget at the end of the month that you can count on. Great, I can do that. It takes me 5 minutes. I can do that. 5 minutes a week for my accounting instead of 4 hours every month in my accounting. That's nothing. So I don't mind doing that. It's still saving me money, and it's a net present value of an increase that I'm getting in my business over time rather than a cost that's coming out of my business over time. So I bet you can wonder about a few things you purchased recently that probably sit in that sort of area, the area where you're thinking, I may have spent some money on something which really wasn't worth it. Or I may have spent some money on a service that wasn't required at all. Or you might have even saved up to buy a computer and realizing you probably would have got a better value if you had rented a computer from somewhere rather than buying it outright. A proper budget, a proper way of laying your budget out and looking at things like calculating the return on investment for putting something new into your business or someone new into your business. When you start to account for these things in a clear and simple way on a spreadsheet, on a whiteboard, written on a screen somewhere, or sitting down with an accountant or a bookkeeper to work these things out, it makes a big difference to whether it's worthwhile doing these things or not, or whether you're just simply buying a new mobile phone because you've got a bit of a vanity thing going on. Thank you so much for joining me this morning and this afternoon. I really appreciate you spending some time, not just working on your business, in your business, but actually working on it to understand what some of these concepts are. They certainly help me with my businesses to grow them to a point where I can understand now what's happening in them. I understand what my bookkeeper's saying. I know what my accountant's talking about. And overall, when it comes down to it, you, the taxpayer and the business owner, are responsible for your own tax arrangements. Even if you pay someone else to do stuff for you, it's still you that is responsible for it. So it's up to you to understand what budgets mean, what tax means, what the implications of your financial arrangements are, to understand that it still sits with you. You don't have to do it, but you do have to understand it so you can say to your accountant or your bookkeeper that, oh yeah, I understand that and I know what you're doing, and yep, that's great. I can oversee that. I can sign off on things and know what I'm signing off on. So hopefully I'll take you on a bit of an adventure. This is one of the driest things I'll ever present because it's certainly not what the social media guy is all about, but it is an important part of making sure I've had sustainable businesses based in the past and now heading in towards the future, that are able to pay their tax obligations, they're able to make purchases and rental decisions and staff decisions that are the right decisions to make, not just because I'm making some sort of emotional response to say, oh, this phone's blue, I want the blue phone. It's not a way to shop, and it's not a way to live, and it's certainly not a way to run a business. Thank you so much again. If you want to watch this again, it'll be available on YouTube a little bit later today, about 2-3 hours time, through the Dante St James channel and as well through Business Station. Thank you again, and have a great weekend.